This video will follow up the video that you had yesterday. That video talked about a company called the Cell Phone Store, and it introduced the concept of cost of goods sold, and that's what topic 7 will deal with. And I want to take what was in that video yesterday and take it a step further and perhaps clarify a little bit what we are doing and why we are doing it in topic 7. We are dealing with the fact that inventory represents what the company buys at one price, and sales represents what the company sells at a higher price. So we need to reconcile that, and we'll see the complications that this brings to the company. So to begin with, let's take a look at where the video yesterday started. This cell phone store bought 100 cell phones, and they bought them for cash, we assume, and they bought this as inventory. So the company, the cell phone store, had to pay $50 a piece for those cell phones. 50 times 100 is 5,000, and that was represented in two T accounts here. And remember, we haven't used T accounts in a while, but remember, they are meant to be a skeletal view of the ledger so that we can see where the money should end up. So this simple transaction means that inventory goes up. That's an asset account. It's debited by 5,000. Cash is also an asset account, and it is decreased, so it would be credited by 5,000. Very simple. So we'll take this now a step further and look at how this and the other transactions talked about in yesterday's video, how they will look in the actual books of the business. So let's look at the journal. Down below there's a tab, and we will show the journal here for the cell phone store. And this first entry has been journalized and posted, and it corresponds directly to the T accounts we just looked at. Inventory is debited by 5,000, just as we looked at in the T account. Cash is credited by 5,000. Both asset accounts, one goes up, one goes down. And we bought these for cash, and check number 101 is our source document. And they have been posted, as you see in the posting reference column. Let's go to the ledger. Let's go to the asset section. And the debit was to inventory, and the date we used was 12/20, and came from journal page 4. And inventory now goes up by 5,000. So the balance is 5,000. We bought 100 cell phones at $50 a piece. So our inventory is valued at 5,000 because that's what we paid for that inventory. Cash goes down. Cash account is credited by 5,000, so the balance goes down as well. And then we put the account numbers back into the journal. So that's very simple. Let's look at the second transaction. We sold 90 cell phones. We didn't sell all of them, but we sold 90. And let's journalize this transaction. And it was a cash sale. So cash goes up. We've had this many times. Cash is debited and by 13,500. And that amount is arrived at by multiplying the 90 cell phones that we sold by 150. So we bought them for 50, but we're selling them for 150. So 90 times 150 is 13,500. That's how much cash we got. And these are sales. So the revenue account is sales, and that goes up. As you know, revenue accounts increase on the credit side. And the source document, the explanation is pretty self-explanatory. Cash sales for the day. So let's post that quickly. We go to the cash account. 12/23/19 is the date. Journal page 4, and we debit 13,500. Cash went up. You can see what happens to the balance now. And account number 101 back into the journal. Then we credit sales. We go to the revenue section. We find sales. Again, we've done this many times. Journal page 4, and the credit is 13,500. And we have to understand that this balance of 13,500 does not represent profit, as we'll see in a few minutes. But that's the amount of the sales revenue that we took in on December 23rd. So 401 is the account, or the account number, back into the journal, and that has been journalized and posted. The third entry on the right, this is the new one, and this is the one that you need to pay attention to in topic 7. At the end of the accounting period, we have an entry called the cost of goods sold entry. This is to account for and to reconcile the fact that we bought some inventory at one price, but we sold it at a higher price. We don't sell the inventory at the same price we paid for it. We need to sell it at a higher price in order to make some money. So this is going to be dealing with that aspect of the sales and the inventory. So let's journalize this. This is done at the end of the accounting period. We will assume it's at the end of the month. The debit goes to a new account called cost of goods sold expense. So this is like any other expense. This is a cost of doing business, as we'll see. In order to stay in business, we have to sell phones. In order to do that, we've got to buy phones from our supplier. So that's a cost that we have to incur in order to do business. So that's an expense. Okay, the cost of goods sold expense, like any expense, is going to be debited. And the amount, what would be the amount? That's the key here. Well, what was our cost for the goods that we sold? Well, we sold 90 cell phones, and those 90 cell phones cost us $50 a piece. So multiply the number of cell phones we sold, the 90, times the cost that we paid for those cell phones, 50, and you get $4,500. That's the amount of the expense, the cost of goods sold expense. The credit does not go to sales. We're not making another sale here. It doesn't go to cash. We're not spending money. We're not gaining money. The credit goes to inventory because that account will go down. Inventory is an asset. If it goes down, it's credited, and it has to be credited by $4,500, as we will see. And the source document or the explanation for this entry is abbreviated COGS. You'll see from time to time, COGS means cost of goods sold, abbreviated. So let's post this. The $4,500 goes to the expense account. In the expense section, there's a new account called cost of goods sold expense. And we said this was $4,500, and that is the cost of doing business for this cell phone store. So the account number is 501, back into the journal, 501, and we credit inventory by $4,500. Back to the asset section, journal page 4, and the credit is $4,500. So this account shows us how much we have in inventory, which means the product that we're going to sell. On December 20th, we had 5,000. That represented the 100 cell phones at $50 a piece. But then we sold 90 of them. We sold most of the cell phones. So we have to account for that. So that's why the credit here is $4,500, which represents the 90 cell phones that we purchased at $50 a piece. And that comes to $4,500, leaving us with a balance of only 10 cell phones at valued at a total of $500. So we sold most of our inventory here. So that's what this account is showing you. So 103, back into the journal. And we've now journalized and posted this this third entry. So as with all videos, if you need to pause and go back and listen to this again, do so, because this third entry is a crucial one to topic 7. Now, let's go one more step here with this video and discuss what the yesterday's video talked about also, and that is the impact of this entry on one of the financial statements. At the end of the accounting period, as you know, we make two financial statements, the balance sheet and the income statement. This impacts the income statement, as we will see. At the bottom of the screen again is a tab that indicates income statement, and this is now showing you the impact of this cost of goods sold. So in previous income statements, for revenue, you simply had sales. Now we still have total sales, and in this business, the only sale we had was that one, totaling $13,500. So the sales totaled $13,500, but that's not profit, obviously. Because we sold 90 cell phones, we have to show that we also had to pay for those 90 cell phones. So that's why this is shown. The cost of the goods sold. What is the cost of the goods that we sold? We sold 90, and they cost us $50 a piece. So 90 times 50 is $4,500. That's the number subtracted from total sales, giving you a gross profit of $9,000. A very important figure for the owners to see. Then there may well be other expenses as well. We're not concerned about them in this particular video, but there may be other expenses. In this case, let's assume they came to $3,775. When you subtract those other expenses from the gross profit, you'll get the net profit or the net income of $5,225. So as I said, review this if you need to. That third entry is a crucial one, and you need to understand the impact of selling merchandise or inventory at a higher price than you paid for it to begin with. And this is how that is accounted for in the books of the business, and then finally in the income statement. At this time, there is a problem for you to do, so go back to your course page and let's do that now.